Hey, this is Bitcoin Asset Research with Allard. Today I want to talk about MicroStrategy's valuation. This is going to be a follow-up video to this video that I did a few days ago where I talked about how MicroStrategy is Bitcoin's only investment bank, and that changes everything about the valuation of the company. I definitely encourage you to watch this video. In fact, you'll probably have to watch this video to really grasp any of the valuation assumptions that are going on in this video. So first off, let me just do a quick rundown of the previous video. MicroStrategy is an investment bank. This is actually their core business. People think that it's software plus Bitcoin holdings. That's not totally true. It's actually an investment bank with those segments, with those two segments as well. Now, their only client as an investment bank is Bitcoin, the blockchain network. And what MicroStrategy does is they specialize in issuing Bitcoin securities, which are just MSTR securities, but we'll see why these are functionally identical later on. So they also have a permanent moat in this regard. The largest corporate holder of BTC, they have the highest vol and the most liquid options activity, most liquid in their spot market too. So all capital raised by MSTR to buy Bitcoin is actually investment banking revenue. So we'll just go through a quick look at how investment banks work. They sit at the middle of the capital markets. They link people who want capital, these are these corporations raising funds, with people who have capital, these are the investors who have money that they're looking to earn a return on. And they facilitate this transaction where capital goes to the corporations, and then the corporations have bonds, shares, securities that go to the investors so they can make that investment. And then the investment bank just sits in the middle, collects this fee for linking these parties together and making everyone happy. MicroStrategy is doing the same exact thing. So here it sits right in the middle between Bitcoin, the blockchain network, and all of these investors. MSTR bonds and shares go to the institutions, goes to these investors, and then capital flows into MicroStrategy and then flows into Bitcoin because MicroStrategy just buys Bitcoin with them. And then in the last video, I mentioned the only stipulation here is that whereas normal investment banks take their underwriting fee in fiat, MicroStrategy collects the underwriting fee in Bitcoin, in BTC. Now, if you accept this explanation, and by the way, I seriously encourage you, watch the previous video in order to follow it completely. But if you accept this explanation so far, then it follows that MSTR's Bitcoin purchases are actually investment banking revenue. So from this revenue, we can compute gross profits. And we compute gross profits by computing what exactly is that cost of revenue and deducting that from the revenue. Everything after these costs, right? So you got the revenue, you take out your costs, that's what the shareholders keep. And this is what we call margins in the business world. What we're really after right now, right, is to find out how much of the revenue per share is retained within the share value after these costs of revenue are accounted for. Okay, so what are these costs of revenue? What are the costs to making these Bitcoin purchases? Well, very simply, it's the interest expenses on the debt issuances, and they're all convertibles at this point, plus whatever dilution impact occur because of convertibles and at the market equity offerings. Each time Bitcoin is purchased, how much of the Bitcoin leaks out of the share due to a combination of these two factors, due to a combination of the interest and the dilution. Now, here's how we figure that out. We come over here and we see some of the deltas between a quarter over quarter period. So this comes from MicroStrategy's Q2 slide for this year. And you can see that total Bitcoin has gone up in this quantity and the total diluted shares outstanding have gone up in this quantity. So I just copy pasted those numbers here. Here's the Bitcoin in the orange, and then these red numbers over here is shares. And this is really in 1,000 shares. So that's why it should really read BTC per 1,000 share. Now, if you do this BTC per share, this is the numbers that you get, right? So all I did was I divided the Bitcoin number by the share number, and I got this Bitcoin per share number. And then I got the change in BTC per share. So that's 8% and 3%. And then there's the change in the total amount of Bitcoin. And that's also reflected right here on the slide. So now we're just looking at, okay, if Bitcoin per share increased by 8%, and then the change in total Bitcoin increased by 13%, how much of that new Bitcoin was kept within the share? Well, the answer to that would just be 8% divided by the 13%. And that ends up being 61%. So the keep rate, how much Bitcoin is kept within the value of the share, is 61%, which means the leakage rate, what is leaked out of the share as a combination of dilution and interest expenses, that stuff is 39%. It's just 1 minus the 61%, right? So, and then when you look at the next period over period, the numbers look pretty much the same. So just based off of this, we can kind of, get a sense that the leakage rate is around 30 to 40%. Now, with that being said, we have everything we need to start valuing this company. So I'm going to move you over to the next sheet over here. Don't worry about all of this. We're going to go through what this means. First up over here, on the left-hand side, all I've done is copy-pasted from Saylor Tracker all of the purchases that Saylor did and MicroStrategy has done over the last 4 years. So this is every single purchase, and the cost as reported is really how much money was spent on the Bitcoin in that purchase. And then the P&L in dollars, that's kind of like the capital gains, the unrealized capital gains that came from the result of that purchase until the present day. So really, we don't have to worry about this too much, but this is the important part, because now we can translate this, we can aggregate all of these things by the year at which they happened and build out what is kind of an income statement, right? So here we have year 2021. All I've done is aggregated the total cost as reported. This cost as reported for the Bitcoin purchase, that's going to be investment banking revenue. So over the course of the last 4 years, this is how much investment banking revenue there is. Now, going back to that leakage rate, right? So we assumed 50% leakage rate as a margin of safety. We saw it was between 30% leakage and 40% leakage, but we're going to assume 50% of the value leaks out just to be conservative. Going to give ourselves room to be wrong in this estimate here. Now, if we assume a 50% leakage rate, then the gross profit is just going to be whatever this number is times 50%, 0.5. So now I'm just going to pull everything here. I divided these numbers by 1 billion. So this would just be the IB revenue in billions of dollars, and this would be the gross profit from the IB revenue in billions of dollars. Okay, and then I filled in the expected amount of Bitcoin that MicroStrategy is going to buy. So I'm expecting they're probably going to do like $20 billion of Bitcoin purchases in 2025. Now, I obviously think this is a little bit conservative, though I wouldn't say it's like necessarily a margin of safety. They obviously announced $42 billion of capital to be raised over the next 3 years. They had a $21 billion at the money offering, and they already expended like $7 billion of those $21 within the first 3 weeks. So I think it's really not far-fetched to say that they're going to spend $20 billion. They're going to raise $20 billion and spend it all on buying Bitcoin in 2025. And then if we assume that same leakage rate, that would be a gross profit of 10. And then here are some of my assumptions for the next few years, although this model doesn't really take into account these assumptions. So we're really just looking at this number. Okay, so scrolling down here, I want to first point out this. You got your share price. This is what I'm reading, market close on Friday. In billions of dollars, it's about $95 billion market cap. The share price was about $422. They had 330,000 Bitcoin. The Bitcoin price, about $98,000 right now. So I'm just going to do some math, and I'm going to back out the value of these Bitcoin holdings and get this number. This is the investment bank's market cap in billions of dollars. But what else is this, right? It's also the premium in dollar terms. So in MicroStrategy, we talk about the premium to the NAV. That's usually expressed as a ratio. This would be the premium expressed in dollars, right? It's how much the market cap of the company is greater than the amount of Bitcoin that they hold. So this is also the premium. They would economically represent the same thing. Now, this would be the market value of the investment bank segment. Now, of course, it would also include the software business, but for now, we're just going to ignore that and say it is all part of the investment bank segment. So we're going to go through the 2024 earnings. That's this number right here, $5.3 billion. And that gives us a PE ratio, right? If we take this number and we divide it by the earnings, that gives us a PE ratio of roughly 12. But PE ratios isn't everything. You also have to scale PE ratios with respect to growth rates. So in MicroStrategy's case, if I'm expecting $20 billion raised next year, then with the 50% leakage rate, that's a $10 billion gross profit. That would come out to 88% growth rate, because you're going from $5.3 billion to $10 billion. So that's 88% growth rate. So the PEG ratio, this is the price earnings ratio adjusted for the growth rate is actually 0.13. So what is a fair investment banking PE ratio and investment banking PEG ratio? Well, we have to look at some comps. So here are some of the major investment banks. We got Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America, then this is Citigroup. So if we look at the GAAP and non-GAAP PE ratios to trailing 12-month and forward, we're getting like this range right here, right? So I'm just hovering my mouse over here. And so I'm just going to say, all right, 16 looks about right. Like 16 is going to be somewhere safe within this middle here. There's obviously stuff that's much bigger than 16. There's some stuff that's smaller than 16, but 16 is looking good. And then for the PEG ratio, again, it's right here. We have PEG, non-GAAP, and GAAP. And I'm just going to say that a PEG of 1 is good, right? So that would be normal for investment banks. And now I come back to this model and I say this is the normal PE ratio, 16, and this is the normal PEG ratio of 1. Now at this point, we are good to do the valuation because we have the actual PE ratio for MicroStrategy's investment bank sector and its PEG ratio. So based on the market value for these investment banks, this would be the implied market value of the total company. So all I've done is I've taken this multiple, divided it by this multiple, and then multiply it by the current investment bank market cap in order to get the implied investment bank market cap based on the multiple of these other investment banks. And then to get the total implied market cap, I just added back the Bitcoin holdings, right? And I got this number. And if I do the same exercise for the PEG ratio, I get this number. So again, these are in billions of US dollars. And this would be the implied upside from the current market cap. Because what this number is saying is, all right, I think that the company is worth this much using our valuation. And then what is the company currently worth? And how much does it need to go up in order to get to this number that I am forecasting? So that's all this is. And at this point, this would be a very basic valuation model. Now I want to tally up some of our margin of safety assumptions. So first off, whatever Bitcoin MicroStrategy gets, we're saying that 50% of them ends up leaking out of the share value, right? And we literally just saw that the number was really between 30 and 40%. And probably in the future, as the stock gets more volatile and they're able to sell more convertibles and monetize the volatility of the stock, the dilution impact will become less over time. So I think 50% is a very high leakage rate. And if we made this 50% number lower, it would increase gross profits, and that would also increase the final valuation of that model. Another margin of safety is that we completely ignored the software business. We completely ignored any of the brand value. So we have MicroStrategy Orange over here. They announced this decentralized identity platform called MicroStrategy Orange. No one's been talking about this, and we also completely ignored this. But who knows? Maybe this might be something that is valuable, but we totally ignored it in the valuation. So that's another margin of safety. Number 3, we took a comparable PEG ratio that is quite low, right? So if you look back over here, it's actually quite low when you look at like JP Morgan has a pretty high PEG ratio, and like at Morgan Stanley also has a PEG ratio that's over 1. So it's really just Citigroup and Goldman Sachs that has this lower PEG ratio. So I think 1 is also kind of low here too. Now the fourth margin of safety, we ignored any ability for Bitcoin to keep going higher. You'll notice that I don't talk about like, oh, in the future, what might the Bitcoin holdings be worth? I simply added up what the current Bitcoin holdings are worth, and I just added it back to the investment bank valuation. That's how I got the final valuation of the company, and I totally ignored any ability for Bitcoin to keep going up from here. And then the fifth margin of safety is we ignored all option value on the Bitcoin treasury. What do I mean by this? Well, the company has a huge amount of Bitcoin. It always has an option to do something with that Bitcoin. So it can lend it out. It can stake it in DeFi protocols, right? So they can do all of these random things to generate additional income from the Bitcoin treasury. And the option to do those things is something of value that the company holds. So by the very fact that it holds the Bitcoin, it has this additional intangible value that should be added to it because it is this capital base that can be deployed in potentially productive ways. So that is yet another margin of safety. It's good to pack your models with a ton of margin of safety because it means you have room to be wrong. This is exactly what I did when I dove deep into HUT8. The stock has basically 3x'd since I first gave it a strong buy rating. You can see the video for HUT8 over here. This was the Seeking Alpha article that I wrote on it. And you can see the price at publication was like $8.80. And currently HUT8 is trading at over $24. So it's basically over 3x'd since I recommended this. And you can see if you go through this video, the same margin of safety assumptions that I'm trying to build into my valuation model. So this is what you want to do. Find stuff where you have a ton of margin of safety and therefore a ton of room to be wrong, because you're probably going to be wrong in a lot of these estimates. Now, if you like this video so far, I just ask you to like it, subscribe to the channel, share it with somebody, leave a question or a comment. You can see on all my videos, I'm very responsive to questions. So please do comment. It definitely helps. Help me make these videos and my thesis better with your feedback. Now let's work to make the model more aligned with reality, because there's actually still a lot of work we can do. MicroStrategy is a monopoly. It is Bitcoin's only investment bank so far, and it has a major moat. It has the biggest Bitcoin stack, has the highest volatility, most liquidity, and monopolies deserve a higher multiple. So I just made a lot of claims over here. Let's go through it, right? So the two main things is MicroStrategy is a monopoly, and then monopolies deserve a higher multiple. So I'm just going to address the second thing first. Why do monopolies deserve higher multiples? Well, number one is Econ 101. The pricing power of monopolies, that translates to more profits. A monopoly can control the pricing structure of the market, set prices what they want it to be, and that translates to maximizing profit. This is a very theoretical explanation. I'm not going to go into the charts and graphs for proving this kind of stuff. It's outside of the scope of this video, but I'm just saying generally monopolies do better at business. Second thing, investment capital from market participants who want industry exposure in that company. All of that capital must be concentrated into a single ticker, into a single company name. So this creates this interesting thought experiment where you're like, okay, so let's say there was this industry, but only one company could do that one thing really, really well. So if I wanted any exposure at all to it, like I would have no choice but to just buy that stock. And with all of this money coming into that stock, that's going to push the price higher, which is going to lead to a higher multiple. So that's another logical explanation for why monopolies have higher multiples. And then the third thing is we can kind of observe this empirically. If we look at the market for chips, NVIDIA is this clear market leader, and it also has a consistently higher multiple than the rest of the pack. So this is kind of evidence, right? You can kind of empirically observe that multiples are higher for market leaders, which means that is approaching what a monopoly situation is, because a monopoly is obviously the de facto market leader, that everything else is just like nothing compared to the single monopoly giant. You can also see the same thing playing out in the oil industry. In oil, there's really two big players, that's ExxonMobil and Chevron, and they also have consistently higher multiples than the rest of the pack. So what should the higher multiple for MicroStrategy be, right? So as an investment bank for Bitcoin, what should be priced above the normal multiple of an investment bank? I'm just going to guess 2 to 5x of what we were working with. And we'll come back to this later because we have the second question to be addressed. Why is MicroStrategy a monopoly? Like, why is it able to maintain such a moat? It really comes down to this understanding. Bitcoin's investment bank must mean that you can issue Bitcoin securities, because that's what investment banks do for their client. They issue securities of that client. Now, your securities cannot be Bitcoin securities unless you have extreme exposure to Bitcoin. So MicroStrategy is the only thing with extreme enough exposure. And we're just going to go through the scenarios so that you can see why this is. First off, the capital structure is leveraged Bitcoin, which means that it's over 100% exposed to Bitcoin. It's kind of like you taking a leveraged Bitcoin position in your trading accounts, except rather than being subject to margin calls, the capital is much more permanent and it's non-callable. The stock is much more volatile than Bitcoin. So that also is the market validation that the capital structure is indeed over leverage of Bitcoin. Now consider if Microsoft bought Bitcoin. Consider this scenario. They're actually thinking about buying Bitcoin. This is something the board is considering and will be voting on. So Microsoft would not be extreme exposure to Bitcoin. Microsoft has a huge amount of other assets, and it also has equity value because a gigantic amount of cash flows come from a business that is totally unrelated to Bitcoin. So in that sense, even if it bought Bitcoin, it still won't have like that extreme exposure to Bitcoin. It won't be pure Bitcoin. And I just want to point out that even the equity value of MicroStrategy's investment banking business, that's still extremely related to Bitcoin. So MicroStrategy securities are actually Bitcoin securities, but no one else can really say that. Microsoft securities are not Bitcoin securities. And so Microsoft cannot be a Bitcoin investment bank, at least not to the degree of caliber that MicroStrategy can. So now here's the opposite case. We consider Microsoft one of the absolute titans of the market right now. Now let's consider what happens if a super small company with very little cash flows and very little assets, what happens if they load up on Bitcoin? Well, chances are they can get to 100% Bitcoin exposure. They could probably get to over 100% Bitcoin exposure. But this is the problem. That company won't have an options market because it's already very small, right? Like this was our premise. It won't have an options market. And the options market are absolutely essential for people to price and hedge the various securities offerings, right? So convertible debt on MSTR, that is hedged and it can be priced via the options market because convertible debt has an option attached to it. So you would use options to price it and hedge it. Oh, and here's another thing. The small company, and probably the bigger ones too, they're never going to have a Bitcoin stack as big as MicroStrategy. So MicroStrategy has like 300K Bitcoin right now, actually a lot more than 300K. But buying 300K Bitcoin, that doesn't cost 300K times the current Bitcoin price. It's going to cost much, much more. I think a lot of people don't realize this because you drive up the price just by buying something. That's problem number one, because your demand as it enters the market, it's going to push up the price. Right? Because all price comes from a supply and demand. So by the fact that you're saying I demand this good, the supply of that good just became more constrained, and that pushed up the price. Problem number two is other people is going to front run you. So if you are making the announcement that you want to catch up to MicroStrategy, well then people know that you're a buyer at any price. They're going to bid the price much higher, and then they're going to try to sell it to you at a higher price. So you're not going to get the current Bitcoin price, certainly not. And if you try to do it covertly, it's still going to come out through other means. Like people would be, like the market would be able to sniff this kind of stuff out, and then you'll have these smart traders that do front run you. It just won't be as big as if you went very public with that announcement. Problem number three is as the price of Bitcoin goes up, other people will FOMO into it, and that's going to push the price up even higher. So now your buy-in price is going to be way higher than whatever the spot price is. So like it's unrealistic to assume that just because somebody has 300K times the current Bitcoin price in cash, that they would actually be able to get to 300K Bitcoin. Also, here's the thing. Even if you get to 300K Bitcoins, MicroStrategy will probably have issued more securities and bought even more Bitcoin, right? So you're kind of competing with this moving goalpost. Your buying is going to drive up the value of MicroStrategy's Bitcoins, and then the value of their stock goes up, and therefore their ability to buy more Bitcoin through securities issuances also goes up. If you cannot have more Bitcoin than MicroStrategy, then clearly they are a bigger Bitcoin investment bank than you are. So they're going to crush you in this competitive industry. So just to recap, right? If you're small, you won't have options and you won't have enough Bitcoin, even if you can get the right Bitcoin exposure. If you're big, you're likely not going to get enough Bitcoin exposure because of your unrelated cash flowing business that has this equity value that's unrelated to Bitcoin. But you might be able to have the options market, which would support you in this endeavor. But either way, you'd still be missing a very crucial piece of it. And if you're super, super big and you try to chase MicroStrategy's Bitcoin stack, you're just going to drive up the value of MicroStrategy's stack and its equity value so much, and it's going to create this moving goalpost for you. So it's not a good idea to try to compete in this regard either. So that's why it's a very, very big moat. This is what a moat is. It's something that defends the castle, defends the business from being overrun by competitors. Although in MicroStrategy's case, that moat probably looks more like this. It's literally the ocean itself. So monopoly premium, we're going to go with 2 to 5x monopoly premium and price that back into our assumptions. So here's the 2x monopoly premium, and we'll have these PE and PEG ratios are multiplied by 2. And then there's the 5x monopoly premium, and we'll have the PE ratio and PEG ratio multiplied by 5. Now I did grade this out because I think a PEG ratio over 5, we don't want to go too crazy with our assumptions here. But using just the 2x multiple, if we just do the same calculation again, these are the numbers we get. The implied market cap upside is going to be like 113% up to 1,266% if you use the PEG ratio. And if you use the PE ratio for the 5x monopoly, so this would be an 80 multiple on the PE, then the upside for the market cap is still 383%. Now, there's a very important thing I have to mention. Just because the market cap goes up this much does not mean the share price will, because MicroStrategy does a ton of dilutions. So the share price is actually going to go up much slower than the market cap. We can actually see this happening in real time throughout history. So this is the 3-year chart for MSTR stock, and you can see the price return was 511%. And then here we have the market cap chart for MicroStrategy. So it started at $7 billion and now it's at $94 billion. So this is a 12x increase. And here a 500% gain is only a 6x increase. So you can clearly see that the price return did not match the market cap increase. So it was actually like half of the market cap increase. So we have to be careful about this. Just because we're saying the market cap is going to go up this much doesn't really mean the price will. We should probably like cut this thing in half or something like that. Okay, so now let's just recap all of the valuation we've done so far. Got $95 billion market cap, 420 per share. The market cap expectation based on this model is $800 billion to $1.3 trillion of market cap. That's a 8 to 14x increase from where it currently is. The actual share price movement, we're just going to half this, right? It's going to be 4 to 7x from here. So that comes out to between $1,700 and $3,300. And then here's my bear case. About a $120 billion market cap. That's a 26% bump from here. And then 506 per share. And the reason why I went with 20% is because at these levels, when it's much smaller gains, the decay rate from dilution, it's not going to be as broad and as large. So ultimately, this would be like my official final answer for valuation. And I just want to remind us that we have established some significant margins of safety. If we relax those, then $2 trillion of market cap is probably feasible in that like bullish case. And here's just the tally up of our margins of safety thus far. Now, hold on, because there is an interesting brain teaser for you here. If you go back to how we did the valuation and go back to how we did the gross profit estimate, there is actually within there a 6 margin of safety, which I have not mentioned. If you're valuation inclined and you want to do a tough brain teaser, consider what happened and think about what is the 6 margin of safety. It's arguably bigger than all of these things combined. And here's a quick hint. It has to do with how we looked at gross profit, whether it is at the enterprise level or at the share level. So leave a comment of what you think it is. I will be responsive and then reveal the answer. So that's the video. Thank you so much for watching. I hope you enjoyed it. If you like this video, leave a like, leave a comment, subscribe to the channel, and yeah, I'll see you in the next video. Bye.